Traders keep searching for new indicators, new tools, new strategies. But one man solved the market centuries ago using nothing but candles. His name was Munehisa Homma. In this video, I'll show you the 5 candlestick patterns he relied on, why most traders misuse them today, and how to apply them correctly in modern markets. In this video, you'll learn the 5 candlestick patterns that still work, the Tonkachi candlestick pattern, the Nagareboshi candlestick pattern, the Doji candlestick pattern, the Tsutsumi candlestick pattern, and the Harami candlestick pattern. How to read these patterns as market behavior, not signals. Where these patterns work and where they fail, how to use them with context, key levels, and trend alignment, and a simple, practical way to apply them without indicators. Before we get started, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss the next trading lesson. Let's get started. The first candlestick pattern Munehisa Homma relied on is called Tonkachi, which translates to the hammer. This candle appears after a sustained decline and signals that selling pressure may be coming to an end. Homa observed that when price keeps falling and suddenly prints a candle with a small real body near the top and a long lower shadow, something important is happening beneath the surface. Sellers managed to push price lower, but they couldn't hold it there. Buyers stepped in aggressively and rejected those lower prices, forcing the market to close back up. That long lower wick is not random. It represents rejection, and more importantly, strength returning on the buy side. Homa described this moment as, when the shadow grows long below, the market is telling you that the fall has reached its limit. In simple terms, the Tonkachi marks a shift in sentiment. The sell-off is losing momentum, and informed participants may be stepping in. Today, this same candle is known as the hammer or a bullish pin bar, but the psychology behind it hasn't changed. It still represents rejection of lower prices and the potential for a bullish reversal, especially when it forms at a key support or demand level. Now, look at this real chart example. The market was clearly trending lower and eventually reached this support zone. Price bounced briefly, then returned to the same level. This time, a Tonkachi candle formed, showing that sellers attempted to continue the move down but failed again. That failure is the signal. Sellers lost control. Buyers absorbed the pressure, and the market was now positioned to move higher. And as you can see, that's exactly what happened next. Price reversed and pushed upward, confirming the message of the candle. So if the Tonkachi is such a powerful candlestick, why do so many traders still fail using it? Because they trade the shape, not the situation. Most traders see a hammer candle and immediately think, reversal, so they buy, without asking a critical question. Where is this candle forming? A Tonkachi in the middle of a range means nothing. A Tonkachi during strong bearish momentum means nothing. In those conditions, that long lower wick is often just a pause, not real rejection. Now, here's something important to understand. Munehisa Homma could trade this candle almost on its own, and it worked, because markets were slower and cleaner at the time. Today, markets are faster, noisier, and heavily manipulated, so the candle alone is no longer enough. The psychology behind the Tonkachi hasn't changed. The market environment has. That's why today, this candle only has meaning when it appears. During a clear trend, after a retracement to a level, at a key support or demand level. Without that context, traders are simply guessing. Now let me show you this on the chart. As you can see here, the market makes a very strong move. The candles are aggressive, there are almost no red candles, and price breaks above the previous resistance. This type of move is not random, it's an institutional move. The origin of this move is what we call a demand zone. Institutions don't enter the market all at once, so when price retraces back to this zone, it's very likely to react again. Look at what happens next. As you can see, the market retraces back into the zone, and once price reaches it, a Tonkachi candle forms. Here, this candle has a high probability of working, not because of its shape, but because it appears in the right context. And look at what happens next. As you can see, the market moves up exactly as expected. Let's now look at the opposite of the Tonkachi, the Nagareboshi, commonly known today as the falling star or shooting star. This candle forms after a strong uptrend and signals that the market may be losing strength. When you see a candle with a small real body near the bottom and a long upper shadow, that's the Nagareboshi. It tells a very clear story. Buyers managed to push price higher, but they couldn't sustain it. Sellers stepped in aggressively and rejected those higher prices, forcing the market to close back down. That long upper wick represents exhaustion. Buyers are losing control and selling pressure is starting to build. In his writings, Munehisa Homma described this moment in a very poetic way. He said, "When a light burns too bright, it cannot last until dawn." What he meant is simple. When price rises too fast and too aggressively, it often runs out of fuel. The Nagareboshi is the market's way of warning you that optimism has reached its peak and a correction may follow. Now look at this chart example. As you can see, the market was moving lower and created this key resistance level. After that, price started pushing up again and returned to test the same area. When the market reached this resistance zone, a Nagareboshi, also known as a shooting star, formed. This candle tells a very clear story. Buyers attempted to push price higher, but they failed to hold those levels. Sellers stepped in, rejected the higher prices, and regained control of the market. According to Munehisa Homma's logic, this type of candle signals weakness after an advance and warns that a reversal may be starting. And look at what happened next. As you can see, the market moved sharply lower, confirming that this Nagareboshi candle was an early sign of exhaustion and weakness at the top. Now, this is important. The Nagareboshi doesn't work everywhere. If this candle forms in the middle of a range, or during strong bullish momentum with no resistance above, it often fails. In those conditions, buyers are still in control, and the candle becomes noise, not a reversal signal. The Doji was one of the candles Munehisa Homma paid close attention to, not because it predicts direction, but because it reveals hesitation. It appears when the market opens and closes at almost the same price, showing that neither buyers nor sellers were able to take control. Homa didn't see the Doji as a signal to act immediately. He saw it as a question mark. After a strong move, the Doji tells you something important has changed. The side that was in control is no longer pushing with confidence. Momentum is slowing, and the market is deciding what to do next. This is why a doji after an aggressive rally or sell-off often precedes a reversal, but only if the next candle confirms it. However, not all dojis mean the same thing. When a doji forms inside a strong trend, it usually does not signal a reversal. Instead, it reflects a short pause, a moment where the market absorbs orders before continuing in the same direction. In that case, the doji is not weakness, it's consolidation. This is why location is everything. A doji near a major support or resistance level can warn of a turning point. A doji in the middle of a trend often signals continuation. Homa's insight was simple but powerful. The doji doesn't tell you what will happen, it tells you to wait. The next candle is what reveals the market's true intention. Now let me show you this on the chart. As you can see in this chart example, the market was trending down and sellers were in control. The market breaks this support level strongly and then pulls back to retest it. Once price revisits the level, a doji candlestick appears. This doji does not signal weakness. It represents a pause. The market is simply taking a breath after a strong push lower. Sellers are still in control, but price needs a short moment to absorb orders before continuing. This is important because if you missed the initial move, this pause is the market inviting you to join the trend, not warning you to exit it. Now look at what happens next. Right after the doji, the market resumes its move and continues pushing lower. Sellers step back in, momentum returns, and the trend continues exactly as expected. This is why context matters. In a strong downtrend, a doji is often not a reversal signal, it's a continuation pause. The same logic applies in an uptrend. Now look at another chart example. Here, the market was trending down, then it reached this level and reversed, forming a key support level. Price retraced back and tested the same level again, and at that point, a doji candlestick formed. This doji indicates indecision at this level. It shows that sellers who previously pushed the market lower have lost control, and buyers are likely stepping in to drive price higher again. Now look at what happens next. This doji worked not because of the candle itself, but because it formed in the right context, near a key support level. Now, it's important to understand where the doji doesn't work. When a doji forms in the middle of a range, it has no real meaning. In that environment, buyers and sellers are already in balance, so the candle doesn't signal a decision, it's just noise. As you can see, this doji formed here and didn't work. Another one formed here and it didn't work either. And another one here. Again, it didn't work. However, this doji did work because it formed at this key support level. This is why the doji should never be traded on its own. Without location and context, it offers no edge. Now let's move to the next pattern. The next candlestick Munehisa Homma paid close attention to is called Tsutsumi, which means to wrap or to engulf. For Homa, this candle was never just a shape on the chart. It was a clear statement of dominance. When one candle completely covers the body of the previous one, Homa interpreted it as a shift in control. One side didn't just respond, it overpowered the other and erased the emotion of the prior session entirely. He described this moment with a powerful idea. When one day consumes another, the market's intention has changed. In practical terms, this is what Tsutsumi represents. A bullish engulfing forms after a decline, when a strong bullish candle fully covers the previous bearish one. This shows that buyers have stepped in with conviction and taken control of price. A bearish engulfing appears after a rally, when a strong bearish candle swallows the prior bullish candle. This signals that sellers have seized control and are now dictating direction. What made the engulfing candle special to Homa wasn't its size, it was the emotion behind it. It showed that hesitation from one side had been completely crushed by conviction from the other. In modern price action, we see the same logic at work. An engulfing candle near the bottom of a decline often signals a bullish reversal. Near the top of a rally often warns of a bearish reversal. And within a trend, after a pullback, it can act as a continuation signal. Homa's principle was simple but powerful. The emotion of the past is trapped inside the new candle, and the stronger side has already made its decision. Now look at this chart example. Here, the market is trending up, which means buyers are in control. Price reaches this level and reverses, forming a resistance level. When the market tests the same level again, it forms what we call a bearish Tsutsumi candle. This Tsutsumi, which forms at the resistance level, indicates that sellers have taken control from buyers at this area. Buyers are no longer able to push the market higher, so a reversal becomes likely. Chartists often refer to this structure as a double top, which represents a failure by buyers to continue pushing price upward. Now the context is in our favor. Without this context, the Tsutsumi candle should be ignored. And look at what happens next. As expected, the market moves down. The next candlestick Munehisa Homma paid close attention to is the Harami, what we now call the inside bar. In Japanese, Harami means pregnant, not because of symbolism, but because it describes containment. A smaller candle forms entirely within the range of the previous larger one, showing that price has stopped expanding and is now being held in place. To Homa, this candle wasn't about direction, it was about compression. He saw the Harami as the moment when the market's energy tightens. Volatility contracts, movement slows, and traders hesitate. He described it as a pause before the next decision, a moment where strength is quietly building beneath the surface. After a strong move up or down, a Harami often tells you that momentum is slowing and that a possible reversal could be forming. But during an active trend, the very same candle can act as continuation, representing nothing more than a brief pause before the trend resumes. Now let me show you how this plays out on a real chart. As you can see here, the market was trending lower and then started to move sideways, forming a short consolidation, what we call a range-bound market. After some time, price broke above that range, signaling a potential trend reversal. Right after the breakout, an inside bar formed. This pause is completely normal. After a breakout, traders hesitate. Some expect continuation, others fear a false move. Uncertainty returns briefly, and that's exactly what the inside bar represents. Homa didn't see confusion here. He saw opportunity. For him, the inside bar after a breakout was the market saying, "Wait, confirmation is coming." His approach was simple. He waited for price to break the inside bar in the direction of the new trend. And as you can see, once price broke above the inside bar, the market continued higher with strong momentum, confirming the continuation. Now, it's important to understand where the Harami does not work. During a range-bound market, inside bars inside the range should be ignored. As you can see, this inside bar didn't work. This one also didn't work, and this also didn't work. Remember, context important, and without context, no candlestick pattern works. Before we move on, there's one important thing you need to understand. These candlestick patterns are not meant to be traded one by one as isolated signals. Each of them plays a different role in telling you what the market is doing at a specific moment. Some candles show rejection, like the Tonkachi or the Nagareboshi. They tell you that price tried to move in one direction and failed. Some candles show a pause, like the Doji or the Harami. They tell you that momentum has slowed and the market is deciding what to do next. And some candles show commitment, like the Tsutsumi. They tell you that one side has taken control and erased the hesitation. The goal is not to memorize patterns. The goal is to understand the phase of the market. Is the market rejecting prices? Is it pausing and compressing? Or has it already made a decision? Once you understand that, candlesticks stop being random shapes. They become a language. And when you read that language in the right context, the market starts to make sense. Now let me show you a very simple way to use this. Nothing complicated, no indicators, just logic. Now let's look at another example on the US dollar Japanese yen 15-minute chart. As you can see, the market was ranging. Then the price breaks out of the range and starts moving higher. This is a clear shift in momentum. Buyers are now in control. After the breakout, the market retraces back to test the upper boundary of the range, which is the resistance level that has now turned into support. Once the market reaches this key level, a doji candlestick forms. What does this tell us? This doji indicates the end of the retracement and the potential beginning of a new impulsive move in the direction of the new uptrend. Now let's look at the higher time frame to see if our setup on the 15-minute chart is aligned. As you can see on the higher time frame, the market has started trending up. We have the first impulsive move, followed by a retracement, then another impulsive move, and now another pullback. When price reaches this resistance turn support level, it is slightly rejected. This tells us that buyers are defending the level and that another impulsive move is likely. This higher time frame behavior supports our trade idea on the 15-minute chart. Now let's switch back to the 15-minute chart to execute the trade. We place the entry at the close of the candle, set the stop loss slightly below the key level to allow for normal market fluctuations and avoid getting stopped out, and target the next resistance level. And as you can see, the price moves up and reaches the target. Now look at another chart example. This is the Australian dollar Swiss franc 5-minute chart. As you can see, this is a clear demand zone. The move away from the zone is strong, the candles are large, the previous resistance is broken, and the risk-to-reward ratio is attractive. If you're not familiar with supply and demand, make sure to check out the video on my channel where I cover this topic in detail. This zone represents institutional activity, and when price retraces back into it, there is a high probability that the market will move higher again. Now look at what happens next. As you can see, the market retraces back, reaches the demand zone, and a clear Tonkachi candlestick forms. You can perform a top-down analysis by checking the higher time frame to see if it aligns with this setup. However, with strong setups like this one, I sometimes take the trade even without higher time frame confirmation. The entry is placed at the close of the pin bar, the stop loss is placed below the zone, and the target is set at the next key level. And as you can see, the market moves up and reaches the target. This example clearly shows that when we analyze context first, trading candlesticks becomes much easier. However, this is not a holy grail. Even when you trade with context and alignment, you will still have losing trades, and that's exactly why risk management is king. Now we've reached the end of this tutorial. If this video helped you see candlestick patterns differently, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next lessons. Thank you for watching, and I'll see you in the next video.